Want to welcome you to today's seminar, co-hosted by FMA and the Finance, Economics, and Banking Research Network, which we call FEBRN. Today we have Albert Menkveld, who will be presenting today's seminar. And with that, I'm going to pass it to my colleague, Cesario Mateus. Cesario?
Thank you, Michelle, and a warm welcome to all our participants around the world. As Michelle said, we have today with us Professor Albert Menkveld. Is Professor of Finance at University in Amsterdam. And to moderate the seminar today, we have Miloš Božović, Professor of Finance at University of Belgrade, Faculty of Economics and Business in Serbia. And without further ado, I pass it on to you, Miloš.
Thank you, Cesario. It's my great pleasure to introduce our today's speaker, Professor Albert Menkveld. He's a professor of finance at Vrije Universiteit Amsterdam and fellow at the Tinbergen Institute. His research is in the areas of securities trading, liquidity, asset pricing, and financial econometrics. Professor Menkveld has published in many distinguished journals, such as the Journal of Political Economy, the Journal of Finance, the Journal of Financial Economics, and the Review of Financial Studies, among many others. 3 years in a row, he was the best publishing Dutch economist. According to Google Scholar, he has over 9,000 citations so far. Professor Menkveld is currently associate editor at the Journal of Financial Economics, member of the Royal Netherlands Academy of Arts and Sciences, research fellow at the Center for Economic Policy Research, member of the Capital Market Committee of the Netherlands Authority for Financial Markets, and member of the Advisory Committee of EuroCTP. He received multiple grants from the Netherlands Organization for Scientific Research, the Pearson Medal from the Royal Dutch Economic Association, a Lamfalussy Scholarship from the ECB, and the Joseph de la Vega Prize from the Federation of European Exchanges. Without further ado, Professor Menkveld, thank you for accepting our invitation, and we're really looking forward to your presentation. The virtual floor is yours.
Thanks, Miloš. Are you okay? Can I recruit you for my PR department? That would be brilliant. Thanks a lot for this lengthy introduction. Yes, I care about liquidity. I care about financial econometrics. But I also care about understanding the stuff that we have in our data. And one thing that's always been very high on my list was to do something about the VIX, because the VIX, commonly known as the fear index, is something that for my work, I've visited many trading floors, and if you randomly pick a trading screen of a trader, there'd always be some window open that has the VIX and where it's going. And I wanted to understand what's driving the level of the VIX, what should the essentially what are the fundamentals that make a VIX be high relative to volatility, realized volatility, and when is it low or is it on par? I mean, that's something that I think we need more research on. And so I've been venturing out on an existing model and see if I could find the equivalent price of VIX in that model, and liquidity is going to be key. I hope to convince you of that. Now, I have 45 minutes, which is very generous, 40 minutes after the lengthy introduction, I guess. But we have 50 minutes of engagement, and I encourage you to ask questions and to help me bring this paper to a next version. So let me start sharing some slides, because I did bring some slides with me here. That's going to be helpful in communicating the basic ideas to you. So this is the title. I've just settled on this title last week, Equilibrium VIX. We have something to say in an equilibrium model about the level of VIX, and it's going to be tied to liquidity. So meaning markets here are not fully elastic, in the sense that if I keep sending buy orders into the market, price won't be at the same level that it was at. The price is going to respond. I mean, in microstructure, my field, we know that for a long time in asset pricing, people start to understand that with the inelastic hypothesis, work that Gabe and Koyen is working on these days, and many people in the field. But we understand that if you send orders into the market, directional orders, the price is going to move as a result of your orders. And that in and of itself, those liquidity effects, I think, might be tightly related to the level of the VIX. And I hope to convince you of why it is. Starting with an example, earlier this year, we had so-called Trump Liberation Day. You might remember, there's so much news about Trump, you might actually have forgotten, but I'll tell you, he was basically coming on screen with a big list and say, I'm going to impose tariffs on the rest of the world, and this is going to be the level for each and every country. That was a huge event. For the first time in recent history, we're moving back from a globalized, frictionless economy to actually tariffs and more of autarky, I guess. And the markets responded. This was on Wednesday, April 2nd, and the VIX there jumped 71% in that particular week. The S&P 500 index dropped by 10% in the course of that week. There was a ton of trading there, and if you want to trade the index and you want to be trading cash, then you'd be, one popular venue to trade the index at is exchange traded funds. So people were trading the SPY, which is one of the most actively traded exchange traded fund, ETF. So there was a ton of trading in the aftermath of this, but, and this is surprising to people like me, lots of trading, very illiquid markets. Illiquidity, by the measure I used here, jumped by 160%. So you have essentially no liquidity, but a lot of volume. And I think those things are related to where the VIX was moving later that week. Over and above what volatility, of course, there's a volatility increase, but typically, and we know that, and I'll show you that in this presentation, the VIX at these type of instances jumps a lot more than expected realized variance. So let's say the Garch effect jumps much more than that, and it stays at elevated levels for much longer than actual volatility, than realized volatility. And I'll become very clear about these terms later. But I just wanted to say that I just wanted to put some picture in your mind as to what this paper is about. Okay. All right. These gentlemen, I should make them call office really, because they've written this beautiful paper, Liquidity and Asset Returns, a while ago, in a review of financial studies, and they're both very they're both excellent scholars in the sense that they don't cut any corners. So every I is dotted and the T's are crossed, as they say, I think in English. And I admire them for that. So the best part of this paper is actually in the appendix, I would argue. And it's written beautifully. And the idea for this paper that I'm presenting came from the very first part of this appendix, where they develop an expression for expected utility when of something that is linear in a payout. Let's call this dividend, but also in the second order term, so dividend squared. They develop that term and show that it's this analytic expression. But mind you, what you have here, you have expected utility not only for dividend, but also for dividend squared. And if we talk about dividend squared, then we're almost there and thinking about variance. That's the second moment right there that's being priced, and that's where this is going. So motivation, I've given you some motivation. Another really beautiful quote that I wanted to show you here was by Bill Dudley, New York Fed president. This was a time around 2017. The years before showed very low realized volatility. So if you took, and let's fix ideas now, I'm going to talk about monthly realized variance on the S&P 500 index. So what you do is you compute literally for every month the close-to-close daily return on the S&P 500 index. You square it, you add it up, and that's going to be your realized variance. That's what you get when you buy realized variance through a variance swap. And the price of those variance swaps. So that's what you get when you enter the long side of a variance swap. At the end of the month, you're getting this sum of squared returns. At the start of the month, you have to pay something to the other side, to the short side of the variance swap. That is called implied variance. That implied variance, Peter Carr, the late Peter Carr, has shown that's approximately equal to the squared VIX. So you can think of this, and I think you should think of the squared VIX as being the implied variance, as being what do I need to pay now at the start of the month to get at the end of the month the sum of squared returns. And that's key. That's key here. Now, this was a period in Bill Dudley where the implied variance, so the price of these variance swaps was huge, yet the realized variance on average was really low. And so in a very narrow econometric sense, implied variance was a poor predictor of realized variance, expected realized variance, or average realized variance. But asset pricing theory tells you that it's not a predictor. For those of you who know, implied variance is going to be computed under the alternative measure, the Q measure, whereas realized variance is computed under the P measure. And the difference is that we're for each and every state, we're multiplying the state with the marginal utility of the agents, and that will become clearer later. But what is important about this quote is people out there don't understand that sometimes implied variance or variance is huge, is very costly. VIX is very high, yet the realized variance could be very low, and that can be made consistent. Squared VIX is implied variance. I just made that point. Approximates the price of a variance swap. Carr and Wu are the references. Very beautiful papers. I've reread them a few times. So we can work with a variance swap to understand VIX. So I'm going to interchangeably use implied variance or squared VIX. The pricing of variance is non-trivial in the following sense. Let's go back to the first moment, and let's take the simplest possible world where we have a dividend. You get paid the dividend. You have a concave utility function. And so a risk-averse investor with this concave utility function will never buy a stock that's trading at the expected dividend. It has to be below, because the expected utility of dividend is below the utility of expected dividend, and we know that as Jensen's inequality. Jensen's inequality no longer works when you run price not the dividend but the squared dividend, essentially the variance. And why is that? Well, you still have expected utility there, but the expected utility is now working on squared dividend. The squaring itself is a convex function. So you've got a composite function now of utility being concave and the squaring being convex. So we don't know what the end product will look like. That depends on the utility function. So we can't make general statements from first principles like the VIX should always be, or squared VIX or implied variance should on average be above expected realized variance or below or at. It really does. There's no guidance from this type of thinking, from Jensen's inequality here. And so we have to do more. So what are the empirical facts? Well, for those out there that trade these products, you know that on average, implied variance is above realized variance. And the variance swap, therefore, which pays realized variance, and if you want to be paid realized variance at the end of the month, you have to pay implied variance now to the other side. The difference between that is called the variance risk premium. That's simply implied variance at the start of the month minus, when you're sitting at the start of the month, implied expected realized variance. Empirical research has shown that the variance risk premium is positive. And this is, I would argue, non-trivial, because you get paid a random variable at the end of the month, yet you're willing to pay more than its expected value to be paid that random variable. So that sounds like the world upside down. So investors pay for risk, they pay to be long the realized variance because the variance risk premium is positive. So this is ultimately a deep dive into what could be driving that particular fact, which is, puzzling from first principles. As I said earlier, with my example, the variance risk premium surges after crashes. So that wedge between implied variance and expected realized variance, it becomes elevated after crashes. And I'll show you in some data work I've done for this project that it's, I find the same, but it's not my credit. That's these papers out there that have shown that. So we have these two things we want to understand or somehow get our heads around. And could liquidity help? So the common explanation is, and this is a hugely cited literature, Bakshi-Kapadia, Boleslav Tauchen, Zhu, and Todorov, hugely cited, very good papers, but they ultimately, in my view, they need some sort of exogenous asymmetry. They rely on an asymmetric gauge feature that's out there that's driving returns, meaning if you have a negative return, large negative return, then the increasing variance going forward of future returns is larger than if you have a large positive return. Some people call this the leverage effect, but I call it asymmetric gauge. I mean, that fits the data wherever you are in the world. That's fitting the data very well. Now, outside of the model, if this is the process driving returns, then what? Then it sort of makes sense for me to be long. It sort of makes sense for me as an investor to like being long variance because that typically, on average, associates with large negative returns. And if that associates with large negative returns, it's sort of a hedge against a negative return. And that explanation is built in these papers. And I'm not arguing with that explanation. That explanation is out there. But I want to see if there's something in addition that liquidity can add. Or, from a more purist theory point of view, is there a way for me to generate a positive variance risk premium without importing an asymmetric gauge process? So suppose everything's symmetric, and I still get the variance risk premium. That's the task I set myself. Literature, there's even other explanations for the VRP. I don't have time to go through them. But they typically have nothing to say about that volume and the illiquidity patterns that I alluded to earlier in episodes of market crashes. And I want to get an understanding this elevated VRP around these crashes. Market makers have been zoomed into. I'm using the Vajanos and Wang model, which is a general equilibrium model, so I don't have a separate market making sector. Market making is sort of endogenously created. And I'm using the trading models. This is the tradition that I'm working in. Grossman-Miller is a landmark paper there. I'm going to use the Vajanos and Wang framework to develop my insights. This I already said that there's an inelastic markets hypothesis that says that if you want to trade, the fact that there's that sometimes the assumption that's often used in classic asset pricing models that trading is free just doesn't hold. You trade in a particular direction, the price is going to move in that direction. All right. So what's the intuition? And then I'm going to get to the nuts and bolts, and I'm going to hopefully convince you that this is not just hot air that I'm producing, but there's some real mathematical content. But to get the idea across, I thought it'd be good to go back to one of the classics in my field of someone else I highly admire, Hans Stahl. And unfortunately, he passed away too. But this is a picture from one of his early papers that has this pattern that, and he's been looking at some data to prove that this is the case. If you have a large block trade that you're trying to get through, in this case, it's you're trying to sell a large block of shares, prices typically respond more than the information that's in your trade. You might have information that you're trading on, but even then, prices overshoot the information that's in your trade. Prices overshoot the information that's in your trade, and that's exactly the inelasticity of the markets. And this is already look at that at the early 70s where we have that result. Hans Stahl was one of the founding fathers of the inventory risk type of market making. And therefore, whoever's on the other side to take that trade, you're posing risk on to them. If they're risk averse, they'll only accept the trade if you give them a very friendly price. In this case, they will have to trade on a price that's below fundamentals. Then only will you induce the other side to accept the position that you're essentially pushing onto them, and that becomes inventory for them. But in the process, and this is key, in the process, look at this, prices overshoot the fundamentals. So you get this dynamics in prices that they tend to overshoot. So in a sense, the way the image I always develop in my mind when I think about Hans Stahl's work is that, yes, prices, fundamental price could be thought of as a random walk, but you sprinkle on the random walk, on top of it, you sprinkle some white noise, some stationary process. And then if you sprinkle that on top of this, because of these liquidity effects, these block type trades, what you get if you compute the volatility of those returns, they're going to be larger than the volatility of the fundamental value changes. And this is all I have for you today. This is all I have for you today, because what's happening now is that if you're an investor standing at the start of the month, you might be the one who has to liquidate for some reason. And in the Vajanos and Wong type framework, it's going to be called non-traded risk. I'm calling that liquidity risk. There's some probability that you'll have to unwind, be forced by your clients to sell part of your portfolio. No choice. So you create this block type dynamics. You're going to lose on the trade because you're pushing prices below fundamentals. And if this were a really large trade, a really bad shock, you're going to lose a lot of money along the way as a fund manager, as a portfolio manager. But hey, if you enter a variance swap at the start of the month and you get paid realized variance at the end of the month, because there was so much liquidity effects, realized variance was huge. And you're getting that. So you're getting that as a shocked investor. You're getting paid the realized variance. So part of that loss that you made on all of those trades, you get back by getting realized variance, which is contaminated, which is these fundamental price changes, but contaminated with liquidity effects. But that's what you get paid. Isn't that beautiful? And that's the core, that's the engine of the model. That's the intuition right there. All right, this is not questions for you. This is questions I ask myself when I write this. So we're not yet at Q&A time, I mean to say. This is the question I set myself up in this paper. Can I generate, with this liquidity effect that I just provided you the intuition for, can I generate a positive variance risk premium? 1. 2, can I get an analytic expression for it? That would be beautiful, because then I can take partial derivatives and start understanding what drives the variance risk premium. Number 3, can I somehow rationalize crash patterns, that we've got this elevated variance risk premium after a crash? Can I generate that? And to do that, I bring in some data, and I'm going to calibrate the model before the crash situation and the after the crash situation, and it provides me insight into what could be going on in a crash. In particular, it provides us some insight in what could be driving the trading that people do after crashes. Remember, more volume, but a lot less liquidity. So why do people trade? Jump in VRP, elevated volume, but also lower liquidity or higher illiquidity. So I've got some theory, I've got a calibration, and I conclude. That's basically where I am now. So let me give you the gist of the theory. I don't have time, of course. All the derivations are in the paper. So the model is the Vajanos and Wong model. So that's a published model, and I don't change anything to it. It's a model in the spirit of Grossman-Miller. The only thing I'm doing, I'm introducing a variance swap in this model. So a derivative that is a zero mean supply. That's what I'm doing here. What is the model like? Well, you have 3 periods. in the intermediate period where all the action is, a fraction of the agents get this liquidity shock. And that's in the spirit of Lohmann by Wong, a JPE paper. That was the source for the Vajanos and Wong paper. Contribution of my work, maybe an analytic expression for price variance, but really the credit goes out to Vajanos and Wong, who have sort of that result already in the appendix, but I had to work through and do the administration to get the right expressions. Key ingredients: financial markets, risky asset, and a variance swap. 3 periods. At the end, at the final period, it's very standard. There is a dividend that gets paid, and its average is mu v, and the variance is sigma square v. In the intermediate period, but we don't need that to make the deeper argument, but some of the dividend level is revealed. So we have the final dividend is going to be the sum of V2 and V3, where V2 is revealed in the intermediate period. So investors learn something along the way. But again, that's not key. That's just to make, I've added that to calibrate the model to the data later, where that's key. But it's not key to generate the insight of positive variance risk premium. A fraction kappa of the agent suffers this liquidity shocks. And how do they model that? Well, first off, with some probability, you're going to be in that set. You become a shocked agent. What does that mean? What you get pushed onto you is this shock Z, which is some realization. On average, it's 0, but it could be positive, could be negative, times V3. So it's basically some additional exposure, positive or negative, to that dividend that's paid out in the final period. The reason they model it this way is that this liquidity shock makes you want to trade, right? Because you can undo some of that shock that get pushed onto you by trading the asset, because the asset pays you V3. So that's the engine of their model. There's nothing that I do here. What I've added here is a correlation between what's revealed in the intermediate period V2 and Z. I pushed that to the polar case, meaning perfect correlation. So what I want to capture here is what's in the data, that typically when there's a negative return or a large positive one, I mean, the model is symmetric, people trade in that direction on average, like aggressively trade in that direction. The aggressive side of trades is in that direction. And that's gonna happen here, because if you have a negative shock, if this correlation is negative in V2, so the market, the fundamental value of the market of the S&P 500 index, let's say, is dropping, we get shocked, we get a positive shock, and to undo a positive shock, you have to sell the asset. So you have people that are shocked who want to sell the asset exactly at the time when it's negative. They want to buy the asset at exactly the time when the dividend that was revealed is positive. That is something that I have here again to fit the data. I don't need to make the point in the paper. Importantly, at period 3, the variance swap pays the delta P, so the change in prices, which is essentially the squared returns that I'm after. Steps in the game: final period, dividends realized, agents learn the remaining component, the risk asset that pays the V2 plus P33, and therefore the price is equal to the sum of these two dividends, all the uncertainties being revealed. The long side of the swap here pays, the long side of the swap receives V, which is again that sum of squared price changes. In the intermediate period, dividend is revealed partially. That's the V2 is revealed. But importantly, the agent learns his type. Either you're a shocked agent or you're not. If you're a shocked agent, and now I'm driving towards the data, you become a liquidity demander. You want to trade that asset because you can hedge some of the shock that you have just experienced. And the others in this model, they become the de facto liquidity suppliers. So they're happy to take some of that shock only if you compensate them for it. That's the liquidity premium that they demand. And that's being determined in equilibrium here. But the mechanics are the same as the Kraus and Stoll paper I just showed you, the Kraus and Stoll graph. So that's where the trading is going on. And in period 1, finally, the agents are homogeneous, and ex ante they're homogeneous. The risky asset price can be computed and is invariant and Wong. So that's the beauty of this model. We get a perfect characterization of the return process, the first difference in prices. We have an expected realized variance that we can compute, which is simply the expectation of those price changes squared. And we have the price of a variance swap. And now we appreciate being paid the squared returns. We appreciate them with the marginal utility of the agent. The marginal utility, and this is key, of this agent here is going to be with probability kappa. He's becoming a liquidity demander. He has some marginal utility that's different from this marginal utility when he becomes a liquidity supplier with 1 minus kappa. So that's gonna drive a wedge between these two, y1 and x1. X1 is the expected realized variance. Y1 is how much am I willing to pay for the variance swaps being at the start of the month at T is 1. And that's exactly what we're after. That's the variance risk premium. I'm going to take a quick look at the clock. I have 15 minutes left before we're going to Q&A. I'm going to take a sip of my coffee. I suggest you do that too. Or you might have another drink, depending on your time zone. But now we're going to have some formulas, some propositions, and I'm going to give you a taste of the calibration, and then we're done. There's a technical assumption. I don't have time to do that. The derivations are available as a Mathematica notebook online. After my non-standard errors work, I started to realize I should be a lot more disciplined in making my work reproducible. And I do that by sharing code for my empirical papers. Here I share the derivations in a Mathematica notebook. So hopefully this should help convince you that the mathematics is kosher. Proposition 1 says that the value, and this is the key proposition, of the variance swap can be computed in closed form analytically. And it's essentially a weighted average of y1. So what's the appreciation of being paid realized variance if you become a liquidity demander? 1 minus kappa is what is the appreciation of being long the variance swap if you're a liquidity supplier. So the weighted average of these two is going to be the price of your variance swap at the start of the period. And this is the way to compute these things. You have to be very careful with a matrix algebra, with linear algebra. But if you do that, I claim that what you get is the following. You get an expression for y1, which is the price of the variance swap, the implied variance, squared VIX. And look, it looks very complicated, but it's really not. If you stare at this long enough, it becomes very friendly. Because what you have here is you've got the variance of dividend of the part of dividend is revealed in the final period. You've got essentially, forget about this term for a moment, you've got the squared sigma V2. So you've got the variance of the part of the dividend that's revealed in the second period. And then you've got this extra term here. This is in closed form the liquidity effects, the overshooting, the Krauss and Stoll effects. So that's what's added onto variance. That's what you get paid out also when you're paid out realized variance at the end of the month. And that is the key part of this thing. And then there's two inflated terms here. I call them inflator terms, this one and this one. And it turns out that you can compute them, and they look like this. But importantly, both those inflator terms, I wrote them out at the bottom of the screen here. This is the inflator term for the intermediate, for the second period return. And this is the inflator for the final period return. They're both larger, or at least weakly larger than 1, meaning that y1 is larger than the expected realized variance. If I put kappa to 0, which is always a useful exercise to do here, kappa to 0 means I've removed the friction. I'm essentially in a frictionless world. Nobody gets any liquidity shocks. Kappa 0 gets us the b squared and the b, if I put kappa to 0, gets 0 here, so 1 over 1, this becomes 1. So this whole inflate has become 1. And so you get the implied variance to be exactly equal to the expected realized variance, which are these terms. Now this one drops because there's no liquidity effects, this kappa is 0. So we get essentially the price of the variance swap is equal to squared dividend, which is the sum of these two components of dividend. So that's just something, but the moment I move kappa away from 0, I make it slightly positive, I get this wedge to start to increase. In other words, the variance risk premium starts to increase. I claim it's non-negative and it's increasing in some of these, in the size of the friction. As a picture, here is the core picture of the model. The fact I said earlier, and this is calibrated to the S&P 500 index returns squared over a month, that it's 400 if I don't have any friction, any liquidity friction. The expected realized variance already itself starts to increase when I move kappa up. So when I start shocking agents that have to trade within a month, then we have liquidity effects, and those liquidity effects are going to increase expected realized variance because prices overshoot. This is just expected realized variance. I haven't talked about the implied variance yet. Then, if I compute to be paid the expected realized variance, or to be paid the realized variance, to the value of that to a liquidity demander is computed here. So these guys really like to be paid this for reasons I already gave you earlier, because they've suffered a lot of losses. At times, in states of the world where the losses are largest, they get paid most, and that's what they appreciate. And this is in closed form how much they appreciate it. For liquidity suppliers, on the other end, they appreciate it less than the expected realized variance. Why? Because these guys become slightly wealthier in a way, because they're the ones who weren't shocked, but they get essentially to earn the liquidity premium, and so their wealth increases, and therefore the marginal utilities decrease. But standing at 0, I have to take the average of these two, and now it's going to be the question like, does this one increase or no? Or does this one, more precisely, does it stay above expected realized variance? And it does, and that's something you have to prove, and that's where I spent most of the work on. That took me a few months to get my head around that, but I managed to prove it. Proposition 2 is the price of so this wedge, the variance swap increases monotonically in the fraction of shocked agents. I've already given you that in a picture. The red line, the wedge between the red line and the blue line was increasing with kappa. It increases in the level of risk aversion. It increases in how large I make the liquidity shock or the endowment shock. The last 2 bullet points are no surprise, but to get the increase in kappa was non-trivial to me. So I had to do the calculation. It turns out to be true. Corollary, I don't have time for that. I want to give you some calibration. So the sample I have here is 1993 to 2025, daily VIX from the CBOE, daily S&P 500 index, so SPX is the acronym for that, from Board's NASDAQ. Intraday trade data for SPY, because I want to compute the trading. I mean, ultimately, I want to match liquidity effects, so I need to be able to compute how much people were selling the ETF or buying the ETF on a particular day. So then we call that the signed volume in microstructure. So you sign each and every trade with who initiated it, plus if it was a buyer-initiated trade, minus if it was a seller-initiated trade. And then you add all those trades for a particular day, and you know if there was in total buying or selling. And that's important to get the size of the liquidity effects. And then I create monthly data where for each month I compute at the start of the month the VIX squared. So that's the implied variance. And at the end of the month, I'm computing the realized variance. That's sum of squared daily returns, as I said earlier. That's simply the variance swap that's underlying the value of VIX. index and realized variance. Here's the pictures, and I'm emphasizing we have 11 periods in this data sets, and it's including this year, so it's including the Trump Liberation Day, but it's also the global financial crisis. I'm in Europe here. We have the European area debt crisis. I will never forget about that. Asian financial crisis in the 90s. There's all these crisis months, and I'm going to zoom into them because that's why I want to calibrate the model. I just want to go through this quickly because I want to get to the calibration. On average, realized variance is 342. So that's percentage squared annualized. Implied variance on average in this, is it 30 years? I don't know, something like that. In this sample is 444. So the average realized variance risk premium is 100 over a baseline level of 342 is a lot of money. That's 25% that you're earning if you're willing to be short the variance swap every month. Okay, so it's a sizable wedge. What the squared VIX is above expected realized variance. Trade. Here's the trade in the SPY. But what I want to show you, every time there's a crash here, it's hard to see for you probably, but I'll tell you, there's an increase in volume. And every time there's a crash here, the spreads, the effective spread starts to increase, but also the realized spread, so meaning more illiquidity. More volume, more illiquidity. Others have shown it. I see it in the data too. What's the crash pattern? That's what I'm using in the calibration. So here I'm looking months. So I look at the 11 months. 0 is the crash. -1 is the month before the crash. -2 is the 2 months before the crash, etc. So I'm pooling across all of those 11 crises, and that's the beauty of having so much microstructure data these days. That to see if the patterns I see are statistically significant and economically significant. This is the realized variance after a crash, and that's statistically significant. And it's what I said. It's what other people said. The variance risk premium is higher after crashes, meaning squared VIX stays high, but expected realized variance drops quickly. Volume in those months after these crash months, it moves up from 2.5 to about 5, more than 5. So it's a 100% increase, and it's significant. So these are large effect guys. Effective spreads, they go up from 10 to about 15, tens of percentages of increase in illiquidity in the bid-ask spreads that people pay on trading SPY. So these are the effects that I want to calibrate to, and that's where I'm almost done. I just took a look at the clock. I have 3 more minutes. Panel C is what is the key input to the calibration. I have pre-crisis numbers and post-crisis numbers. I'm only calibrating, right? This is not a dynamic model. I'm just calibrating. Can I sort of get the patterns by just looking at them month by month and compute what can rationalize? Let me start again. I'm calibrating the pattern by taking the pre-crisis period and the post-crisis period. I want to characterize like what do the moments look like, and what do the parameters need to be to match these moments. Pre-crisis, I compute the average realized variance is 352 of 354 percentage squared annualized, doesn't really matter the level, and implied variance is a bit higher. Okay, only 5% higher pre-crisis. And then in the interest of time, I'm going to skip over this number. But after the crisis month, and it's not surprising, we have a 3 times higher variance. So compare the 354 jumps to 870, almost 3 times higher level of variance. Implied variance, so that's expected realized variance. Implied variance jumps even more. It jumps a lot more, meaning that we have now, after the crisis, that implied variance is 37% above expected realized variance. So variance risk premium is huge. Variance risk premium is 5% here, it's 37% here. So that's going to enter the calibration. I want to match those patterns. Risk aversion parameter, I set that to 3. That's just what I have from other literature. And the moments I'm going to match here is the pre-crisis variance risk premium, which is 19 percentage square percentage annualized, 319 after the crisis month. The illiquidity jumps by 26% and volume jumps by 81%. And I managed to match that perfectly, which is, I've got 4 parameters to match 4 moments. Sure, if this were a linear system, you always get that, sort of. But this is a nonlinear system, so you're not really sure that the image of the parameters of the function of the parameters, the moments are a function of the parameters. The image might be such that whatever you observe is outside of that image of that function. But in this case, it's not. I managed to generate the moments with the parameters I have. So what are these parameters? I have a pre-crisis kappa and I have a post-crisis kappa, and I have a pre-crisis size of a shock. So if you're shocked, how large is the shock? So this is the extensive margin. This is the intensive margin. And there was some surprising findings here, at least to me, because I thought when you move from pre-crisis to post-crisis and the variance risk premium jumps, I can make that work by shifting kappa out. But that's not what's happening here. Kappa shifted in. Look, it's 0.79 before, it's 0.54 after. So there's fewer agents being shocked. So the extensive margin, fewer agents trade. The reason that's happening, I had to think about this for a while, is that in the model, with liquidity supply, if you have the variance jump up by a factor 3, the liquidity cost or the illiquidity should also jump by a factor 3, all else equal. This should have been 300%. It's only 26%. Should have been 300 given the jump in the variance. It's only for risk-averse investor, it's only 26. In other words, relatively speaking, the liquidity supply was cheap. The only way for the model to make liquidity supply cheap is to increase the number of liquidity suppliers, the non-shocked agents. So if you increase 1 minus kappa, you have to decrease kappa. That's what's driving this part. Then you match this number here. But you still have this one to match, so more volume. And the way that's being matched is by making the shock size larger. So when we look at the crisis, particularly after those months, there's fewer investors that trade the extensive margin. But if they trade a tremendous amount. They trade more. To me, that sounds maybe somewhat reasonable for these periods where if you can, you avoid trading. You want to stay, you want to be stuck where you are. You want to avoid trading because trading is expensive after a crisis. You want to somehow live through the crisis. But some of these funds, they might not be able to. They might work on the risk budgets. They might have clients who are going to make phone calls. They want to reduce the risk, and so you've been forced to sell. And I've been presenting this. It's early work, but I've been presenting this to some industry people, and they say it's a reasonable way to think about the world. That some of the I'm even calling that leverage-induced trading in a model because it's got that aspects. But that's coming out of fitting this type of model to this pattern. Conclusion, I'm out of time. Liquidity risk, so this friction that Vianos and Wang and Grossman and Miller have put the limelight on, that can explain a positive variance risk premium. Only introduce a variance swap in that model, you can price it, you get an equilibrium level of VIX, or squared VIX, I should say. It increases in the fraction of agents who experience the shock. It increases in if these are more risk averse, then yes, these liquidity effects are larger, and of course, if the shock is larger, liquidity effects are larger. The model can rationalize these crash patterns, so it delivers a little bit more than what the other papers out there have been delivering. Remember the asymmetric arch type explanations, because it also explains something about volume and illiquidity. Explains why there's elevated post-crisis VRP, because there's some agents out there who get such a shock that they have to trade, and if they trade a lot. So it's fewer agents with stronger liquidity leads, smaller on the extensive margin, but they have to trade more on the intensive margin. So maybe it's forced deleveraging, and that's all I have for you today. Let me hand it back to Miloš. I hope there's still somebody there.
Thank you, Professor Menkveld, for this great talk. The questions are coming in, so we'll start with this one, for instance. It has been documented in the data at the time of the crisis or dislocation in market, the VRP is initially negative, then the VIX catches up to realized variance. Doesn't your model imply the opposite? And does your VRP predict future stock returns?
Yeah, so this is a great question. Thanks for engaging. I see that in the data too. So I see a huge negative realized variance. A variance versus premium, realized variance versus premium in the crisis months. But I'd argue that is a mechanical that's just coming out of the way these things go, because at the start of the crash month, you couldn't predict that this was the crash month. And so you get this effect that implied variance is still low, but turned out to be a crash month. So realized variance in those months was huge. And if VRP, if you simply compute that as IV minus VRP, that is where you get a negative. And that's not where I think we should be all that puzzled. But what we should be puzzled about is what's happening in those months immediately subsequent to that crash month. And that's where implied variance, of course, increases because people have been observing the crash, but it's increasing to a level that's way larger than the predicted variance based on standard stochastic volatility model like asymmetric arch. And that's where we need to do some thinking and write down some models like others have done and like what I've been doing here.
Okay, here's the next one. If implied variance increases, liquidity will also increase. What happens to the efficiency of the markets? My point is leaning to market quality parameters.
Say that again. So if implied variance, say again.
If implied variance increases, liquidity will also increase. What happens to the efficiency of the markets?
So I'm finding that if implied variance increases, illiquidity increases. Is that what you said, or did you say liquidity?
Question says liquidity.
Oh no, but that's not what's in the data, because if implied variance increases, then illiquidity increases, and then if you talk about market efficiency, I think what the person has in mind is that if there's more illiquidity, then fewer people trade and less of the information gets revealed. I haven't looked at that. Might be true. I don't know. That's not been in the scope of this work.
Makes sense. Am I understanding this right, that the dynamics seems to imply some relation to trend or short-term momentum? And if so, have you exploited this linkage?
I don't see any momentum. It's not in the model for sure, and it's also not in the data. But the person, I might misunderstand the point is making, because if you look at S&P 500 index returns, they tend to be negatively autocorrelated, and that's because of the overshooting I emphasized earlier. The books like Campbell Lowe McKinley on financial econometrics, I think they have that table showing that it's a negative number. It's something to the tune of minus 0.01 or minus 0.05, so it's not huge. But if you condition on periods where volatility spikes up, when there's something going on, these negative autocorrelations tend to become larger, meaning that they're larger in magnitude, so they become more negative. And that's another manifestation. Another way of reading that is that liquidity becomes poor, or illiquidity becomes really, really high in these periods. It's really hard to trade.
Changes in pre/post risk aversion play a role in matching the observed moments. Investors may be more averse to the same level of shocks post-crisis, for example, under balance sheet constraints.
That's a good point. And I've been, I've been working on this for a few years. The papers just come around, but early versions of this, I had actually risk aversion changing in the model. And then I remember that when I was presenting this, then pure theorists didn't like that because if they think that risk aversion is a feature of an agent that's that we should assume to be fixed. Because if we let everything flow for all of the agents, we never get to something that creates any insight. Because if everything moves, then we don't know what could be causing it. But in principle, the insight is correct, that you can explain these things by just raising risk aversion. But people have been pushing very fiercely against this in theory, because it's something we need to assume to be fixed in agents. But that's just a theoretical argument. I'm not saying that this is wrong. This is another way to generate an increase in the variance risk premium. I agree with that.
Yeah. How would you model the speed of adjustment following shocks?
I haven't gone that deep. It's a good point. It's more of an econometrics point because you've got and I showed you the graphs. I mean, these are not step functions. They're slowly moving up and slowly moving down, and there must be some information in the speed. But if you're after that, I think, and this is beyond this paper, but might be worth looking into, you would make this model dynamic and then see, like truly dynamic, and see what the patterns would be for agents in a multiple round game rather than just 3. The point of this paper is just it's very cleanly focused on variance risk premium, and can I create it, positive variance risk premium, based on solely liquidity effects. That's the point I wanted to make, and that's all I have in this paper.
Right. In your calibration, post-crisis periods show fewer but larger liquidity shocks. Could central bank interventions or market structure changes explain this pattern?
Oh yeah, I would like to have more color on what the thinking is behind the question, but there's surely periods where there's a lot going on, and of course all of these crises are different even in nature, where sometimes central banks we know intervened heavily. I'm thinking of the global financial crisis, and sometimes they did not. So I think there's a lot more to be done to understand the many dimensions of the crashes. I was just looking for some common denominator across all of these 11 crash months and see if I could, calibrate the model to do that. And that's all I did. But I'm sure there's a lot more to say about this.
To what extent do futures and options markets contribute to mitigating liquidity risk in financial institutions?
That's a good point, and this is an excellent point, because they could be, one way to think about what I've been saying is I have the agents be the same in the ex ante period. I mean, that's sort of a clean way to write down models that Vajanos and Wang did, but lots of people do, because you don't want to assume heterogeneity right from the start. You want to create it from interaction between agents. But you could think of a world where I make these agents slightly different at the start, where some have slightly more chances of getting the liquidity shock and others don't. And then the variance swap starts to be traded instead of just being valued. In the model here, because everybody's ex ante and there's a zero net supply of these variance swaps, at time one, I need to put it at a level, I need to compute implied variance, I need to put implied variance or the price of that swap essentially at a level at which the representative agent just is indifferent between getting it or no. That's the way we price things. But there's no trade. But if there is that component to it, that some are more likely to get the shock than others, then these people are more likely to get the shock, probably take a long position, and the other people take a short position. And then we've created what the person asking the question is we've got a derivative that's actually creating welfare. So that's a good way of thinking about these type of models and what derivatives do to our markets.
Thank you very much, Miloš. A special thanks to Professor Menkveld, to the willingness to be with us today, and to all our participants. The paper is available in SSRN, so if you want to take a deep look in the paper, is in SSRN in FEBRN research paper series that Michelle kindly already shared in the chat. And once again, Professor Menkveld, thank you very much. Michelle, some last words?
Just echoing my thanks as well. Yes, please check out the paper. It is in the chat. The link to the Microstructure Summer School is also in the chat. And please join us in about 2 weeks for our seminar with Tony Saunders. I look forward to seeing you then. Have a good day.
Thanks, Michelle, Cesario, Miloš, and everybody else. It was great. Thank you.